Welcome to 360 Money Matters, where financial planners Billy and Andrew talk all things financial planning. This podcast aims to increase your knowledge and confidence with all things money. Each week, they will cover topics like wealth creation strategies, investment principles, creating passive income, paying off your debt faster, and much, much more, so you can live a life on your terms without limits.
Hello and welcome back to another episode of the 360 Money Matters podcast. I am Billy and I'm joined by my co-host,
Andrew. Bill's back again. Another podcast, another day after another long weekend.
That's it, Andrew. That's it. But who knows, when this thing gets published, it's probably not going to be a long weekend. So we're recording it, a week or two in advance because of the long weekend.
Exactly right.
For sure. How have you been anyway? You keeping well?
Always well, Billy. Always well, especially after you got a couple of days off and some time to recharge and replenish those batteries.
Nice. So
especially you went up and got some sunshine as well.
I did, and now I've come back to Melbourne where it's 18 degrees, cold, raining. I think I'm getting sick as well too. So
puffer vest is on.
Yeah. You definitely pay the price for heading up north and getting some sunshine. So that's exactly right. Andrew, tell me, what are we talking to our listeners about today?
So today we're talking all about, it's an investment product. It's an investment vehicle. And we're talking all about investment bonds and really how they can be used in a wealth creation plan, who they're suitable for, what the benefits are of this sort of strategy. Not to be confused with a bond. It's actually a different product to what a government or a corporate bond is. In the finance world, we like to use the same word for multiple different products. You would have heard us trying to explain the differences between pension income and age pension and all of that stuff. But no, today is all about investment bonds.
Great. Love this topic because it's something that I've used personally, and we'll talk a little bit about that later in terms of what we used it specifically for. We really rate these as a financial product to enact a particular strategy, and hopefully we get that across to our listeners in terms of the value that it can bring. But in a sort of broad brush nutshell from our perspective, they're a investment vehicle. Just like any other type of investment, you can select the underlying investment options. But the thing that differs with the investment bonds is that they're in a tax-effective structure, which is different to other investment options that we've got available to us. They're concessionally taxed, and we'll talk about the tax rate that's available to them. And from our perspective, and one of the things that we find in the investing world is that in order to really get a benefit from your investing journey, you need to let the compounding interest take effect. So with the investment bonds, there is some limitations in being able to withdraw money out of these things before a certain period of time. We'll also go into that in some more detail. So you've got this product that if used in the right way, it can kind of achieve a whole heap of things sort of all the way across. Andrew, let's talk about the tax rate. What are we looking at with these things to give some context to what I was just speaking about?
Yeah, so look, an investment bond, really, the tax benefits are one of the sort of the main drivers for most people to enter into these types of investment vehicles. So when the investment bond makes an income, earnings are taxed at 30%. So they're concessionally taxed at really a corporate tax rate, and they're, for most people, or for a lot of people, taxed at a lower rate than what their own assessable income is. So within an investment bond, all of the tax is paid within the bond. So you're not having to declare income on your own personal income tax statement. You're actually paying it within the bond. Now, all of this is if you hold a bond for longer than 10 years. So you need to really hold a bond for longer than 10 years in order to not impact or attract personal income tax. And in addition to that, when you're making switches between investment options within the bond, so you can, or most bonds should have a multitude of investment options, you're not paying capital gains tax when you're making those investment switches. Bit of a verbal diarrhea there, but from a tax perspective, it can be a very, very powerful vehicle.
So just to summarize that nice and easy, the tax that's applicable to the investment is paid within the investment itself. So you don't have to worry about completing any admin requirements when you do your tax return year in, year out. If you hold it for more than 10 years, it doesn't get added to your assessable income because all of the tax is being paid all the way along. And it's a tax rate of 30%. So if your marginal tax rate is higher than 30%, there's obviously some benefit here to be able to try and obviously not pay more tax than that 30% rate, like any other traditional investment would get added to your assessable income in the year that you take it out, or the income that you get associated with it as well too. So from that perspective, and with some planning, and hopefully we get that across shortly, but I think it's a huge benefit and really, really powerful tool if used the right way. Andrew, 10-year time frame. Yep. So let's talk about that, and how does that sort of mix in with the strategies that we talk to clients about?
Yeah, so really, I mean, in order to be able to take advantage of these tax benefits in an investment bond, you have to hold them for a minimum of 10 years. So let's say that you establish and start contributing to an investment bond today, then there's a 10-year time frame before you can withdraw the funds, not have that income added to your personal income tax. So you still can, and I guess this is something that we do talk to clients about, is you still can withdraw an investment bond before 10 years. So you can say, okay, I really need the money, I'm in the jam, I XYZ reason, didn't expect this, and I need to withdraw the funds from the investment bond. You still do have the ability to draw the funds out. It's not like a superannuation investment where you need to claim financial hardship or anything like that. You still have access to the funds, however, you lose the tax benefits associated with it.
And I think that's a really valid point to highlight to people. It's not as restrictive as, say, superannuation, where once the money's in, you can't get it out. Although from our perspective, we discourage people from doing that for a whole heap of reasons. But if your circumstances change and you need to get access to the money, you can still do it.
Yeah, exactly right. Exactly right. So you look at the alternative option, which is for most people, if you're not investing in an investment bond, you're looking at a similar investment in whether that's just a wholesale platform, whether that's into some shares or managed funds, you would have paid the tax anyway. So when you compare if I do draw the funds out versus if I had never entered into an investment bond, the opportunity cost really isn't that massive, other than the fact that most investment bonds will have a more restrictive investment mix that you can select.
One of the other things that's fascinating, and we talk about not being too restrictive and things like that, but one of the things that I've always found fascinating is with investment bonds, they've got what's called the 125% rule. And what this is, as the name suggests, but each year, as you tick over your anniversary date, you cannot put in more than 125% of your previous year's contribution. So that doesn't sound too bad, I guess, on the surface, but we'll dig a little bit deeper here. If you put in $1,000 in the investment bond in year one, you've really set yourself up for the maximum amount that you can put in year two, 125% of the original first year's contribution. So that's $1,250 in year two. Let's just say in year three, you decide that cash flow's tight, so you don't put any money in and you make zero contribution that year. You've effectively killed your ability or lost your ability to add any more money into the investment bond, because 125% of zero is zero. So one of the things that you need to be mindful of when setting these strategies up, and it's critical to get advice surrounding these things, but whatever you do at the start kind of dictates where the bond's going to go in terms of what available growth that you've got available. And what I mean by that is if you start at $1,000 a year, just as a round number because the calculations are easier, year two, you're limited to $1,250, and then year three, I think it's $1,550 from memory. But if you then put zero in, you kill it. So you need to try and predict what your cash flow is going to be and how much you want to contribute to this thing over the period of time. And you really need to be able to stick to that in order to maximize the benefit of the bond.
Yeah, so from a contribution side of things, it can be very restrictive. So because of the tax benefits associated with it, and because there's some fairly opportunistic or some fairly good opportunity associated with it, there's some restrictions around how much you can contribute to the amount of 125% of the last year's contributions. Personally, that's the thing that I love about investment bonds, because a lot of the times when you're talking to clients, when you're talking about investing, it's a topic that people just absolutely love, they're really interested in, but it's really hard to shift the client's focus to what is the purpose of what we're investing in? What are we aiming for? What are we trying to get to? And how does this form part of the broader strategy? An investment bond forces that conversation. It forces you to think not only about today, but about next year, the year after, and the year after that. It really brings to the forefront of how much am I contributing? How much should I be contributing? How much am I going to be contributing in a future point in time? And really forces you to think about your finances, your cash flow, and a whole heap of stuff around wealth creation at an earlier point in time than most people ordinarily would.
Yeah, all the things that we love talking to clients about is long time frame and contributing on a regular basis as well too. This absolutely forces you to do it. So yeah, completely agree. Who are these types of, before we get into the strategies around some of the things that we talk to clients about, how these would fit in, who are these investment bonds applicable to, or who are they most relevant for? I mean, pretty straightforward off the bat. If your marginal tax rate is above 30%, obviously that's a pretty given one. So tick that box. What else do we look for, Andrew?
Yeah, I mean, look, if you've got regular and predictable income, investment bonds can be really fantastic because you know how much money is coming in. You should have an idea on how much money is going out. You know what your surplus is. And so putting money towards investment bonds is sort of a bit of a no-brainer, especially if you've got that long time frame. The other one, which I'll probably let you talk about, Billy, because you can draw from your own example of what you utilized an investment bond for, and what I will be in a few months' time. I've got a little one on the way, so what I'll be utilizing an investment bond for. But yeah, Billy, take us through it.
So there's probably two examples. I'll use the specific one that we did for Samantha and I, plus another one that I spoke to a client about recently. But if you've got a specific expense that you're aiming for at a particular point in time, these are really good for that because you know that your time frame is going to be or should be at least 10 years. So in our instance, one of the things that we wanted to do is when our kids reach year 7, Andre's at that stage next year, to be able to put them into private school. So obviously a huge expense going in there. So we started an investment bond. For us, it was in 2011. So we've hit our 10-year mark. We've withdrawn that out. It's just sitting in cash, essentially waiting for the school to send us the first invoice and turn my beard even grayer than what it is. But for us, that was the specific purpose. And we basically reverse engineered. Obviously, we knew when he was born, and we knew that by the time they're 11 or 12, depending on their date of birth, that's when we'd incur that expense. So for us, that's what we did. And really, it was a combination of two things. We kind of reverse engineered how much we thought the fees would be over the 6 years that he's going to be in high school. And then the second thing is trying to predict from our cash flow and our surplus income how much we could put in each year to not too much stress on the budget, but more so to be able to keep that up over the 10-year time frame, because we didn't want to kill a bond and we didn't want to not maximize the opportunity that we had available for ourselves.
And also, whatever you do for the first child, you got to make sure that you do for the next child. So making sure that you're future planning for that as well.
Double whammy, and thanks for reminding me, Andrew. I better get back to work and keep earning some more money. The second thing that I was talking to a client about recently is using a investment bond to cover the gap between their intended retirement age and the age that they can access super. So in Australia, as it currently stands, if you're permanently retired, you can access full access to your superannuation at age 60 if you are permanently retired. In this particular case with the client, they wanted to retire at 55. They're in their early 40s at the moment. So what they were talking about is, hey, how do we fund a period of time between age roughly 55 and age 60 when we can access our superannuation? So they needed to create enough wealth to be able to cover themselves before they could access their super. So in this instance, one of the things that we were talking about is contributing to an investment bond. Once again, from their particular circumstances, they're a higher income earning couple, so they're on the highest marginal tax rate. Obviously, we've got a specific time frame of when they needed to access the money. They had a lot of surplus income and they knew essentially what they needed in order to cover that 5-year time frame. So for them, it lined up quite well and it ticked all of those boxes, and we recommended that particular strategy and that particular product.
Yep. So I think the thing that really highlights is an investment bond is really powerful, especially when you know exactly what it's being used for. So It's to cover private school fees. It's to pay for expense. It's to cover retirement between a certain time frame, and this is how much we'd need in terms of funds. So when you've got a specific purpose, you can pretty easily sort of start with the end result. Okay, I need $200,000 for X expense. Okay, well, this is how much I need to contribute to the investment bond on an ongoing basis. And if I start it with, as you said, $1,000 a year, then I'm probably not going to be able to just purely by that 125% rule. I'm not going to be able to hit that number over a period of time because I'm starting with too little. So I need to increase the initial contribution and make sure that I can sustain that over the next 10 years to be able to hit that sort of desired expense.
That was exactly it. Yep, exactly it.
Love it. Love it.
And just on that 125% rule, that's with contributions. So it doesn't take into consideration your earning or your return on there. It's just from your previous year's contribution, and that's how it's calculated. So there is some complexity specifically around the anniversary date and making sure that you're within those parameters, because if you do breach it, you actually can breach it. You can go above 125%. That's probably something that we should highlight. If you do, it resets your 10-year time frame. In some circumstances, that actually may be the right strategy. But once again, you need to be under advice because it's easy to make a mistake and you don't want to get to year 9, say in my instance, and then make too much of a contribution and reset it right when you're at the finish line and when you need the money.
Yep. Another sort of instance where an investment bond can be another tool in your arsenal is what we sort of utilize it for really commonly in the business is, okay, let's just say a client has a surplus income of, pull a number out, let's just say $1,000 a month to invest, right? Now, you know that $1,000 a month to invest is the maximum surplus income if everything goes to plan, if everything's all good. You don't want to maximize the full surplus income into a growth bond, because if the surplus income dips because someone takes a period off work or there's some unplanned expenses or something happened in someone's life, you don't want to allocate the full surplus income to a growth bond. So one of the things that you can do is, of the $1,000 a month income, we're going to allocate whatever the number is, depending on the circumstances, but $600 a month is going to go towards this investment bond. You've got an additional $400 a month in surplus income. That's going to go towards a more, would say traditional, but what people think of as a traditional investment vehicle, a portfolio of whatever, shares and managed funds. That $400 a month that's going towards the investments that are not in the investment bond, that's the variable portion. If your income decreases for a period of time, if you're needing to make adjustments to your contributions towards your investments, that's the portion that you dial up and down, whether it's frequently or infrequently. That's the portion that you adjust. And the portion that's going to the investment bond, that's the portion that you say, okay, this is what I'm committing to for the long term, and this is what I'm going to do for the next 10 years without making any variations to it unless you're increasing within that 125% rule.
Good strategy, and can't highlight that enough, that when you start these things, you need to begin with the end in mind. And if you can keep it consistent in terms of your contributions year in, year out, or even if you can grow them, doesn't necessarily need to be by 125%. If you can keep growing them incrementally year on year, then that's obviously a positive thing as well too. So really need to begin with the end in mind. And once again, that throws back to needing to get financial advice. But Andrew, talk to us about some of the investment options available, some of the investment bond products that are available today versus the ones of sort of yesteryear are a lot more flexible in terms of what we can invest in. Talk us through some of that.
Yeah, so look, there's a multitude of providers that offer investment bonds. Some have a more simple investment or have a limited range of investment options. So some have their own investment options where you're sort of limited to 5 to 10 different investment options. Others will have 50 or more investment options. So depending on who you're utilizing as the provider for the investment bond will determine what the investment options are that are available. Incorporated within that is also cost. So depending on which provider you're with, they'll charge a different fee for their investment bonds. And so you sort of mix all of that in the blender and look at, what your desired outcome is, what the intended investments are going to be, who's going to match what you want, and ultimately choose a provider from there or choose a vehicle for the investment bond. It's worth highlighting that this is a pretty critical decision. So you can't transfer an investment bond from one to the next without re-triggering that 10 rule. So it's not like you can say, I've chosen with X provider, but I found a better option with someone else. And then you switch and still continue with the fact that you've already been there for 3 years or whatnot. It restarts if you're moving to a different provider from an investment bond. And so making sure that you're choosing sort of the best option available at that point in time or at the time that you enter it is a pretty critical, definitely a very important thing.
And just on that note, in terms of changing investment options, if you wanted to, does not reset or change the 10-year rule. So that's just important to point that out as well too. And from a product perspective, there's actually not a lot of providers in the market that are doing this. We find that there's, without talking particular names and stuff, but there's one particular provider that leads the pack in this space. But a lot of the other providers, your more traditional, sort of well-known, call it your big four, they seem to be winding down their position in terms of their offering. So there's not a lot of institutions or product providers that are actually doing this, which is just an interesting thing to note, because from our perspective, as financial advisors who are talking about this, it's such a powerful tool if used in the right way, albeit there are some limitations and things, but if you work within that, I think it's a really powerful tool.
Yeah, and I dare say, I'm pretty hard pressed to, even when you're talking about pre-retiree clients and almost anyone that you're talking to, it's very infrequent that you've got a time frame less than 10 years. Most people have that time frame, and even if your time frame is less than 10 years, some of the considerations are draw down on a particular asset like superannuation first, and then your investment bond kicks in later because you're either going to do part-time work in the lead up to retirement. You're not just fully going to retire at day one. So really, I think that an investment bond can form and should form a fairly large part of almost not every financial plan, because it's all dependent on what your goals, what your circumstances are. But most financial plans, I dare say, should have something like this within them because of really the fact that you've got that time frame for most people.
Well said. Andrew, cost associated with the investment bonds. I guess it varies depending on your investment option, but what are we looking at from a cost perspective?
Look, it ultimately varies. I mean, it depends on who you're choosing as the provider of that investment bond. It depends on what investment options you're choosing, but really that should ultimately all go in the blender in terms of, okay, what's the benefit that I'm going to get out of this? What's the cost incorporated within that? And sort of the thing that I strongly advocate, especially for something like this, where you've got such a long-term planning thing, really that 10 years, is the cost of financial advice as well. You really should be receiving advice when you're entering into something like this, because you're entering into it with the intention of holding it for 10 years or more. So you want to make sure that it's the most appropriate product on the market. So really strong advocate for receiving financial advice in general, but in particular when you're trying to access investment vehicles as such.
Probably no different to everything that we talk about in terms of needing to get financial advice. But once again, this is a really powerful tool if used in the right way. Not something that's really well known. Not a lot of providers are out there doing it, but in the right circumstances, it's hugely transformational. And it's something that, we're talking to clients more and more about along their investment journey. If you kind of think of, I guess, the traditional tax minimization route of adding additional money into superannuation, okay, that's 15%, fantastic. You're capped out at your concessional contribution limit at $27,500. The next best thing from a taxation perspective is a 30% investment bond from what we've got available to us in Australia. So, that could be another part of the strategy depending on what your surplus income is and if you wanted to contribute additional money into another investment.
Yeah, and it's all about those, whether you're talking about investments, whether you're talking about tax, whatever you're sort of talking about, there's always, it's just getting those extra few percent here, extra few percent there in terms of a tax saving, in terms of another tool in your arsenal is ultimately what's going to mean that at the end of the day, you can retire on the income and the terms that you want to live on.
Andrew, well said, well summarised. I reckon we leave it there. And to our listeners, thank you once again for taking the time to listen to our podcast. Hopefully you got a whole heap of information regarding investment bonds. And if any of it pricked your ears or you think any of it could be applicable to your situation and you wanted to find out more information, reach out. Our contact details, as always, are in the show notes. Andrew, thank you. Good to be on the mic with you again.
Thank you, Billy. Good to be back again. Thanks to our listeners and look forward to catching you on the next podcast.
Thanks for listening today. If you have any questions on what we talked about or would like to have a chat about your money journey, visit us at 360fs.com.au.
Just a reminder to our listeners that the information contained in this podcast is general in nature and it is not intended as personal recommendations for the audience. Please consider whether the information suits your circumstances before acting on it. This information is provided by Billy Amiridis and Andrew Nicolaou of 360 Financial Strategists Pty Ltd, authorised representatives and credit representatives of AMP Financial Planning.